Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Camden Property Trust Annual Report. Camden Property Trust is a leading real estate company that offers a wide range of services and businesses related to multifamily apartment communities. The company's primary focus is on owning, managing, developing, redeveloping, acquiring, and constructing these communities across the United States. The company provides various business services including property ownership, management, development, redevelopment, acquisition, and construction of multifamily apartments. With a portfolio of 172 properties containing over 58,759 apartment homes, Camden Property Trust is one of the largest players in the industry. Upon completion of its current projects, the company's portfolio will expand to include 175 properties with approximately 59,921 apartment homes. Camden Property Trust services and businesses can be summarized into several key areas: property ownership, management, development, redevelopment, acquisition, construction, and multifamily apartment community operations. The Camden Property Trust, CPT, stock has experienced a decline of over 6% in the past year due to several factors. One key contributor is the company's softer financial outlook for 2026. Despite exceeding Q4 2025 core funds from operations, FFO guidance, CPT presented a cautious outlook for the upcoming year, projecting a modest decline in financial performance and negative same-store net operating income, NOI growth. The broader multifamily market has also been challenging, with supply pressures and moderating rent growth affecting top-line growth. Camden Property Trust noted facing supply and pricing pressures in several regions, limiting its revenue gains. Additionally, the company's strategic portfolio restructuring plan, which involves disposing of California assets to bolster its presence in Sunbelt markets, carries execution risk. Analyst downgrades have also contributed to the decline in CPT stock price. Some analyst firms, such as Goldman Sachs and Barclays, have adjusted their ratings and price targets for the company, with some downgrades occurring. These factors combined have led to investor caution and a decline in the stock's value over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted and influenced by various market conditions. On the growth side, strong economic growth leading to household formation and job creation has been a significant contributor. Maximizing property occupancy at optimal levels, increasing rents as market conditions allow, and favorable demographics with a higher propensity to rent versus buy have also contributed to revenue growth. In addition, the performance of stabilized properties in the portfolio, lease-up of newly constructed properties, and acquisition of operating properties have all played a role in driving revenue growth. Furthermore, gains on sale of operating properties and core funds from operations have also been significant contributors. On the decline side, short-term leases and exposure to declining market rents have posed challenges. Repayment of senior unsecured notes and unsecured term loan in 2024 has also had an impact. Impairment charges and decreases in net operating income, NOI, due to dispositions have further contributed to revenue decline. Overall, the drivers of revenue growth or decline are influenced by a combination of market conditions, property performance, and financial management decisions. The company's net income experienced significant fluctuations between 2024 and 2026. Initially, it increased by 136% from $163.3 million in 2024 to $384.5 million in 2025. However, this growth was short-lived, as the net income decreased by approximately $1.1 million in 2026 due to higher taxable income and state/franchise taxes. The profit margins also underwent a change during this period. Although not explicitly stated on page 16, it is implied that the profit margins were increasing due to the substantial rise in net income. The data from page 21 shows that the profit margin increased by 2.2% from $985,037 in 2024 to $1,006,834 in 2025. However, no specific information was provided on page 25 to determine any changes in profit margins for 2026. The increase in net income and profit margins can be attributed to various factors such as improved operational efficiency, effective cost management, or a favorable market environment. The decrease in net income in 2026 may have been caused by increased taxes and other regulatory pressures. The company's financial performance is a key indicator of its overall health and stability. One crucial aspect to consider is whether it is generating positive operating cash flow. According to the latest available data, the company has indeed achieved this milestone. For the year ended December 31, 2025, the company generated a significant amount of $826.6 million in positive operating cash flow, page 27. This is a testament to its ability to manage its finances effectively and generate sufficient funds from its core operations. The generation of positive operating cash flow indicates that the company has a strong foundation for future growth and can invest in new opportunities without relying on external financing. Overall, the company's achievement of positive operating cash flow is a significant accomplishment that reflects its financial discipline and operational efficiency. The company's debt level has experienced a significant increase over the past year. According to the financial reports, the total liabilities rose from $4.104 billion in 2024 to $4.605 billion in 2025, indicating a substantial growth in debt. This increase is also reflected in the interest expenses, which rose by $8.4 million, 6.5% increase, from 2024 to 2025. The company's commercial paper program has also contributed to its increased debt level. At December 31, 2025, the aggregate principal amount of commercial paper outstanding was $590 million, with a weighted average interest rate of 3.84%. This indicates that the company is relying on short-term borrowing to finance its operations, which may have implications for its long-term financial stability. Overall, the data suggests that the company's debt level and interest expenses have increased significantly over the past year, indicating a potential risk to its financial health. Management's primary focus is on achieving consistent earnings growth through a balanced approach that combines property operations, development, and strategic acquisitions. To achieve this goal, they are prioritizing core fundamentals such as maintaining a strong balance sheet, generating positive cash flows from operations, controlling debt levels, and overhead costs. The company is also actively managing risks associated with short-term leases, land holdings, development and construction activities, and cybersecurity incidents. Management acknowledges that these risks can have significant impacts on the business, particularly in terms of construction costs and potential losses if costs cannot be recovered. In addition to focusing on earnings growth and risk management, management is committed to preserving financial flexibility through a combination of cash flows, debt and equity offerings, property dispositions, and other borrowings. This approach will enable the company to capitalize on investment opportunities as they arise and maintain its position in the market. Overall, management's strategy is centered around achieving sustainable growth while managing risks and maintaining financial stability. By focusing on core fundamentals and actively managing risks, the company aims to deliver consistent earnings growth and create long-term value for shareholders. The company's financial transactions involved both acquisitions and divestitures. In terms of acquisitions, the company made a significant purchase in 2025 by acquiring 4 operating properties for approximately $419.2 million. On the other hand, the company also engaged in several divestitures. In 2024, it sold 1 operating property for net proceeds of around $114.5 million. The following year, in 2025, the company disposed of 5 operating properties, 2 dual-phased and 3 others, for a total of approximately $365.9 million. These transactions were made on disadvantageous terms due to unforeseen circumstances. The company has a history of paying dividends to its shareholders. As stated on page 7, it is mandatory for the company to distribute at least 90% of its adjusted taxable income as dividends. This commitment to dividend payments was further demonstrated by the declaration of a first-quarter dividend of $1.06 per common share in March 2026. The payment of quarterly dividends has been consistent, with $1.05 per common share paid in January 2026 for the dividend declared in December 2025, and $1.06 per common share paid in April 2026 for the first quarter dividend declared in March 2026. These payments indicate a strong focus on returning value to shareholders through dividends. There are concerns about supply chain disruption that have been identified. According to a document, these concerns are mentioned on page 5 under risks associated with capital markets, credit markets, and real estate. This suggests that there is a potential issue with the smooth flow of goods or services through the supply chain. However, it appears that inventory buildup is not a concern at this time. A review of other pages did not reveal any specific concerns about inventory buildup or supply chain disruption. That concludes the financial summary for Camden Property Trust. Feel free to comment below, and I will be happy to answer them when possible.